Welcome to the current crypto market. Over the last few days, millions in retail accounts have been completely locked out and wiped off the board, chewed up by sudden reversals and violent fake breakouts. Right now, there is a widespread belief that because Bitcoin bounced off the 69,000 support level, the local bottom is in. Amateurs are treating this green candle as a confirmed ticket back to all-time highs. But the underlying data tells a completely different story. This is a highly calculated, algorithmic hunt for liquidity. Market makers are intentionally dragging the price up to the 72,000 mark to trigger a specific cluster of orders, setting the stage for a structural rejection. By the end of this video, I will show you exactly how this institutional trap is structured. I will also map out the specific resistance zones where Ethereum and Solana face the highest probability of failure. Welcome back to the Crypto Whale Radar. Surviving this week's price action comes down to one skill: recognizing the structural difference between a mechanical market maker trap and a genuine reversal. Let's look at the charts. To understand what Bitcoin is doing right now, we have to look outside of crypto. On the 4-hour time frame, the S&P 500 index recently triggered a mechanical oversold signal on its RSI. The RSI, or Relative Strength Index, measures price momentum to identify overextended market conditions. Because the S&P 500 bounced from that oversold state, Bitcoin is being pulled upward into a sympathetic, short-term relief rally. This micro-bounce is deceptive. The upward green line is nested within a downward-sloping red channel. The supertrend indicator sits in the red, confirming a bearish structure since 2022. Finally, a massive bearish divergence, price making higher highs while momentum makes lower highs, signals underlying weakness. We did see a successful hold of the local support zone between 69,000 and 69,500 over the last 24 hours. But avoiding a deeper drop into the 67,200 downside liquidity block was entirely dependent on the S&P 500 holding its ground. Bitcoin did not show independent strength. It simply followed the movement of the stock market. This current micro-rally is built entirely on borrowed momentum from traditional equities, functioning completely within a dominant, long-term macro downtrend. Market makers operate on mechanical logic. Their algorithms are designed to pull price directly towards clusters of liquidity to fill large institutional orders without causing immediate price slippage. This 3D topographical heat map charts Bitcoin's order density. New liquidity has formed at the 72,000 level. Pushing price here triggers early short seller stop losses, creating exit liquidity for larger players. Once swept, price hits a heavy resistance wall up to 76,000, likely repelling it straight down. Based on current momentum, this push towards 72,000 and the subsequent heavy resistance struggle should play out over the next 24 to 48 hours. However, if traditional equities suddenly dump and Bitcoin breaks below that 69,000 support floor, the move to 72K is aborted. The immediate downside target then becomes the unswept liquidity block at 67,200. The anticipated move to 72,000 is a weaponized stop hunt, engineered to create the exit liquidity smart money needs before the larger macro rejection resumes. This brings us to the overarching rule for the current crypto environment. The altcoin market is completely devoid of independent bullish momentum. Every altcoin's price action right now is strictly subordinated to Bitcoin. They are passengers strapped into Bitcoin's algorithmic liquidity hunting path. We can see this clearly by looking at Ethereum. It has experienced a minor short-term bounce, mirroring Bitcoin almost candle for candle. Ethereum is currently pushing into its immediate local test zone, sitting right between $2,150 and $2,200. But if Bitcoin completes its push to the 72,000 target, Ethereum will immediately slam into its primary resistance. That heavy supply zone sits squarely between 2,200 and 2,400. Looking over at Ripple, the market structure tells a very similar story of limitation. XRP is currently trapped in a sideways chop. It has established a support floor between $1.30 to $1.40, while facing local resistance right around $1.45. Even if it manages to break that local band, XRP has an overarching macro resistance ceiling resting at $1.60. Solana has also shown a brief period of strength, recently holding its local support out of the 88.60 to 90.60 range. But waiting just overhead is a severe resistance block, stretching from $95 to $105. If Bitcoin rejects, Solana will be forced back under that ceiling. Finally, Chainlink continues its sideways chop, completely boxed in. It is trapped between its $7.90 support floor and the $9.50 resistance ceiling. Any perceived altcoin breakout over the next 48 hours is an illusion. Their upward movement is completely dependent on Bitcoin's temporary micro-rally toward its own trap. Moving from theory to execution requires a specific set of trigger conditions. The conditions for a short trade are strict. We wait for a sweep of the 72,100 liquidity level. Immediately after that sweep, we watch the 4-hour chart for a bearish engulfing candle, a technical pattern where a large red down candle completely overshadows the body of the previous green up candle. Executing trades during high volatility liquidity sweeps requires precision infrastructure. If your exchange suffers from order slippage or server downtime when volume spikes, your analysis cannot be successfully executed. This is why I execute on BingX. Their infrastructure is engineered to prevent order slippage and maintain server stability during the specific moments of high-volume volatility we're discussing. If you use the referral link in the description, you unlock exclusive platform deposit bonuses and gain direct access to me for trading assistance when these sweeps happen. While you're down there, hit the subscribe button. This channel is built to keep you on the right side of the data, so you stop getting liquidated by market makers. Accurate on-chain data won't save you if your execution engine fails exactly when the trap springs. Get your infrastructure in order before the volatility hits. Let's review the trade model for the days ahead. Wait for the $72,000 liquidity sweep. Monitor the S&P 500 to see when its borrowed momentum stalls out. Once those align, look for the short entry within the 72,000 to 76,000 resistance block. The golden rule of this market phase is simple. Never enter a long position into macro resistance simply because short-term micro liquidity is being hunted. Predicting Bitcoin's rejection doesn't account for the exposure in your altcoin bags. Click the video on your screen right now to see the mathematical hedging strategy required to insulate your altcoin positions during this specific market phase. Long-term survival in crypto isn't about guessing the top. It requires proactive hedging before the macro downtrend violently resumes. See you next time.